New all-time highs, something we've seen a lot this year in the S&P 500, and it is the gift that keeps on giving. But as we rally to new all-time highs on the back of big tech, is now the time for caution. The S&P 500 equal weight and small caps remain well off their highs, and after today's shocking ADP report, is now the time for caution. And if so, where do we want to be positioned? In treasuries, as rate cuts seem around the corner, or in defensive sectors? Today, that's what we're here to talk about, as well as earnings, sentiment, and the probabilities of a market collapse. Is the economy fragile, or is this the end? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. What a rally here today for the US markets. This is the daily S&P 500 heat map. And the most glaring thing we can see is actually these technology sectors right here. Google, Meta, Income Services, Apple, Microsoft, all the way down to semiconductors was all very, very green, except for Cisco on news that they were going to invest $1 billion or more into AI ventures. But technology was very, very green. That probably had to do with BofA's technology conference. And when tech rallies, the whole market rallies. There's also a couple of other things that did help market sentiment. But yeah, part of the reason was BofA's technology conference put in the work. When the mega caps lead, the market follows. But it was a general risk on day. We saw financials in aggregate put out a green day. Same is true here with consumer cyclicals, industrials as well. It was very risk on versus risk off. We saw utilities deep in the red, as well as staples, and then healthcare, at least the defensive healthcare sectors like healthcare plans, not doing that great. But the other growth sectors of healthcare like diagnostic research, medical instruments, and biotech did very, very well today. So today was all risk on, but the leaders of the pack, semis, up 4.87%, and that's because Nvidia was up 5% plus here on the day. When Nvidia rallies, semis are going to rally. Then we actually saw software, technology in second and third place, all up 2% and above. Then home construction, GDX, XLC, they all beat the SPY. The SPY was up 1.19% here today. And then every other sector actually did really good. I mean, industrials were up 1%, metals, minings 2%, materials, discretionary, healthcare 0.45% for the most part. And it was the defensive sectors that took it on the chin. Look at utilities, staples, real estate, energy. I know energy is not quite a defensive sector, but overall, the value sectors definitely taking on the chin. It was value ahead of growth here today. And there was a couple of reasons for that. Number one, Nvidia gained 5%. It boosted technology as well as semis after BofA's technology conference. And, again, when the mega caps rally, those index flows boost the overall market as a whole. We also got weaker jobs, but strong ISM numbers today, which tamed recession fears and spurred rate cut hopes. So ISM came in at 53.8, the expectation was 50.7, but then the ADP numbers came in at 157 versus 173K. And we're also going to talk about these ADP numbers because when you dive under the hood, things are not as bad as you would think they are. Furthermore, the Bank of Canada also cut rates 25 basis points here today, and that did help overall market sentiment. And all of that in totality meant the S&P 500 put out a new all-time closing high at 53.55. The 5250 zone we've been talking about for a very long time right here was a great buy zone to buy. Had you bought the dip, and now you're sitting pretty on what is very good gains at all-time highs in the S&P 500. And then you look at the overall price action, right? You got some higher lows, higher low, and now this is looking like a higher low in the context of higher highs, new all-time closing high on what is a very strong green candle. I think we probably go higher from here. 5,400 by June OPEX looking very likely. That might even be tomorrow because things are looking a bit upbeat here in the after hours. US 100, the Nasdaq is up 0.7%. The S&P 500 up 0.1%, and then the Russell 2000 actually hanging in there as well. We saw the S&P 500 today put out 1.18% as a gain, the Nasdaq 100 2%, the IWM 1.53%, the RSP 0.6%. So it was the market cap weight did outperform the equal weight, and as you can see this right here, this is the advanced decline line. We made a new all-time high in the S&P 500 and not quite in the advanced decline line, but we are still trending up. And if we do go ahead and put in a new all-time high over the next couple of days, this high will confirm this high. But things are looking a little bit upbeat here in the after hours. Not so much in the IWM, but pretty much flat for the day. Part of the reason why we actually saw a rally has to do with yields. Yields fell for the 5th day in a row, and the key level we've been looking at with regards to yield is actually this 4.3%, is actually this level right here, this 4.326%. We've actually broken below this very key level, and that probably means we can go and attack levels here at 4.2% now. So, even if we do pull back, this is probably going to act as a strong resistance zone, and then we move lower towards this 4.2% area. We had a bit of a fake out here above the 4.5% mark. That's exactly what I said. We're rolling over, and we're actually just following typical 10-year yield seasonality. Normally, January, February, March, April into May, yields rise, and then from there, they normally decrease all the way into the end of the year. And that's probably what we should see. Not without volatility, don't get me wrong, but we should see yields fall into the rest of the year. And this is actually something I did point out on my Twitter. I said there's an 80% chance that the 10-year yield high is likely in for the year. This was on the 4th of May, nearly 4 weeks ago. With Fed QT taper, issuance pressure is reduced by 20%. Long duration TLT risk to reward is asymmetrically skewed to the upside. And that trade is coming full circle. I made that tweet right here on the 4th of May. And the index as a whole is up nearly 5% since then. And I do think we're going to go higher. I think the TLT will probably hit this 94 area, the 96 area, and then the 98 area, and we'll go into the 100 zone, especially now that rate cuts are genuinely happening. We saw the Bank of Canada cut their policy rate, and the rest of developed markets should follow. We saw Bitcoin up for the 5th or 6th green day in a row, trying to take out these highs, trying to form some bullish momentum. And it does look like that is the case because we are putting in higher lows and we are breaking higher highs, but we just need to go put in an all-time high here at the 74,000 level. Let's have a look at gold today. Gold was up 1.23%. Silver was actually up as well, 1.82% at a very critical level. We need to see if we are going to break above this $30 level or if it's going to be used as resistance and moved lower into the $28 region. The dollar actually did gain as well here today, but the market simply did not care. And oil is looking like it's trying to find a bottom after the production cuts by OPEC this past week. But let's dive into the S&P 500 in a bit more detail. So we put out new all-time highs in the S&P 500, but then if you actually go ahead, look at the RSI, we're not actually overbought by any means. So we could definitely move higher into tomorrow's trade, another 50 basis points or so, take us to the 5,400 call gamma resistance. When we get on rallies like these, they normally just keep going. As you can see right here, when we have strong candle bars, we normally get like a bit of sideways momentum for the next day or two, and then the rally just typically continues. Everybody was stressing after we put in this bearish engulfing candle. I did say that you want to buy 5250 and as low as 5200. I was always bullish on that, and look at where we are right now. But looking at the overall price action here for today, it was literally a gap up. Bears had a little bit of a win in the early part of the day, and then it was just higher highs, higher lows, closing at new all-time highs. Very bullish momentum. There's not much to say, at all. I reiterate the exact same thing as yesterday. You want to be buyers of dips at the 5250 area and look to the 5400 call gamma resistance. You want to buy dips, sell rips. Let's have a look at some of the other indices. We can see that they're not quite at all-time highs. The RSP is still well off its highs, but it does look like we've put in a high right here, then a low, then a lower high, but we are starting to form a higher low. And if we go ahead, break this level, we can then look to all-time highs. So quite a bit of work that the RSP, the equal weight, needs to go put in. I think it's the same is true here for mid caps as well as small caps. Looking at the Nasdaq 100, that's an all-time high. That's a very bullish candle. 19,000. I think we're probably going to go ahead and get the 20,000 region here. And again, this was the level I said on the Nasdaq 100. We want to be buyers at 18,300. It was this island reversal where we pulled back. We actually rallied all the way to new all-time highs right here, pulled back, found support, and now we've rallied to new all-time highs. Very bullish. And all this looks like trend continuation. This is literally what a trend looks like. Higher highs, higher lows. So buy dips, sell rips at the 5250 area for the S&P 500. Our goal is 5400 by June OPEX. Now guys, looking at the fear and greed index, after the price action we've seen in the last 3 to 4 trading days, we've actually gone from neutral into the fear territory. So according to this index right here, we should actually be looking to nibble on S&P 500 on our favorite indices, on our favorite stocks, simply because if we do move into the neutral camp, into the greed territory, we're going to have outsized returns. That being said, we do need to be slightly cautious with our positioning and not go all in at once. We should be scaling into positions because we can actually move into the extreme fear category. However, this isn't a reason to get bearish. It's just a reason to get incrementally more so bullish, because eventually this will push into greed territory. This will push into extreme greed territory, and you'll be ever more so glad you did buy. So when we do pull back in markets, when we do get sideways action in markets, when we do get the price action we have in the last 2 weeks, which is the market pretty much going nowhere, but still trading near its all-time highs, the money is made by those who are patient and by those who follow the process. And the process is buy the dips, wait, don't trip. Now guys, I got some very interesting data here from BofA, just something regarding the S&P 500 and just the state of the stock market in the last, 100 years. They go on to say, while the dip buying trends have generally been strong since the introduction of the Fed put in the late 80s, they have been particularly strong over the last 2 days. S&P 500 one-day returns after down days, the calendar year average. And essentially, on a red day, if you had bought the dip, this is the return you can expect the next day. Fairly positive returns. You're looking at anywhere from 0.2 to 0.3%. However, I actually went and did a scan, and it was, had you bought the close of that red day and held until the close of the next day, and what is the return you can expect? You would actually had 653 counts, 0.68% average return, 82% win rate. That was from the year 2000. And that was the return from close to close versus this data set, which is the next day's open to close. And don't expect this to change in a low inflation or disinflationary environment where yields fall with a supportive Fed. Expect buying the dip to continue to work in the short term and the long term. With that being said, the breadth in the S&P 500 rally this year has been historically low. It's been led by a small number of stocks. This is true. This was only exceeded in 2007 and 1998, each near the end of historic asset bubbles. Now this right here is the ratio of market cap weighted and equal weight S&P 500 calendar year returns. And you could see when the market cap weighted returns was 2x that of the equal weight, it normally preceded it down here and was often the top for asset bubbles. And this is actually what we're seeing right here, 2023. And so far in 2024, the RSP has returned about 5% for the year. The S&P 500 has returned about 10%. So that begs the question, are we in a bubble, and are we near the end of that bubble? According to data from BofA as well, the recent price action has actually been muted compared to what we saw during the tech bubble, particularly relative to the explosive growth witnessed in 1998 to 1999. This is Nasdaq 100 returns, realized vol and max drawdown for the tech bubble 95 to 2000 and the AI wave 2022 and beyond. And you can see this right here, this is what we did in the tech bubble, and this is what we're doing kind of now post the COVID rally. We are not even close to what, and you can see that 2022, 2021, when we had the everything bubble, that was not even close to what we saw here in 2022. And that means that even though stocks are rallying, a lot of it is being backed up by earnings, monetary and fiscal, and it has less to do with speculation. And in that regard, I think what we're seeing is just a couple of winners at the top that benefit most from those economic trends, stuff like Nvidia, stuff like Microsoft, Meta, and Google. And that's why we're seeing the market cap weighted indices rally. So do I believe we're in the bubble? No, I don't. Why? Because tech companies are super profitable. They're the most profitable companies. They have the best balance sheets. And the reason why they're rallying is because as much as they are a growth play, they're also a flight to safety and flight to quality play. And that's why they're outperforming. They have immense market dominant positions, almost monopolistic effects, and generally people will flock to those, and that's why they're outperforming. So when we see these stats right here get to something like this that we saw in the late 90s, early 2000s, that's when I would start getting worried. But until then, the market action we're seeing right now is completely dependent on the macro side, fundamental side, and not necessarily the technical speculation side like it was here during the tech bubble. Now let's talk a bit about small caps. Over the last week or so, we've actually seen rates come down quite significantly but we have not seen small caps come down quite significantly, and that can actually present opportunity because the correlation between rates and yields in the IWM is very distinct. Generally speaking, if rates go up, the IWM falls, and vice versa. They have an inverse correlation, and we can see this here with the data. We can actually see that when rates go up, this is a 5-day change in the 2-year yield, the 5-day return of the IWM tends to be negative. However, when rates go down, the 5-day return of the IWM tends to be positive. And this has largely been on the backdrop of a tougher macro environment, particularly over the last 2 to 3 years. So where do we stand with rates right now? This is the CME's FedWatch tool, and according to this FedWatch tool, the market is pricing in a 55.3% probability of a 500 to 525 Fed funds rate in September, and then roughly the same 48.3% in November. And the implication here is that we get anywhere from a 25 to a 50 basis point cut in this period. So right now the market is saying we probably get our first rate cut in September, if not by November. And this right here, this is actually, I think, 4 days after the US election. So very, very interesting. And this is actually starkly different because I do believe that the market actually didn't price in a September rate cut just a couple of weeks ago. After the softer economic data we've received in the last couple of weeks, we've actually seen rate cuts move from this November period all the way up to the September period. And it's yet to be seen what's going to happen with the FOMC in June and July. Do I expect rate cuts in these months? It's really going to come down to what the NFP and inflation data is going to look like this week as well as next week. Now let's talk earnings. We're going to dive straight into Lululemon because it was the biggest stock that reported earnings here on Wednesday. So looking at Lululemon's earnings, now they actually posted a double beat. They beat EPS of $2.39 by reporting $2.54, and that was on revenue of $2.21 billion against $2.2 billion. That was the expectation. They also gave us guidance figures, and things were not looking so good on the guidance front. The expectation was $3.01. Management came out and said anywhere from $2.92 to $2.97 was the Q2 EPS guide. That was on revenue of $2.4 to $2.42 billion against the street's expectation of $2.45. Management also said they were going to increase share buybacks by $1 billion. And this is what the stock did here in the after hours. It was up 10.34%. And when you have a stock that does this on weaker guidance against what we've seen this earnings season, this only tells us one thing, and that coming into this earnings, expectations were extremely low and the stock was actually underpriced. The street obviously thinks, based on this price action right here, that even on a lower guidance, Lululemon is probably fairly valued. I'm sure these buybacks did help as well. But generally speaking, when you have a guide lower than the street's expectations and then a rally 10% after hours, that's generally the sum of the rally into the quarter. Generally what happens, again, when you have something like this, right, where you report a beat on earnings but softer guidance, is that the stock normally peaks out here and then we normally drift lower into the next quarter earnings to see if they can actually beat these numbers. And if they can, then we'll get another pop. Generally speaking, when stocks do continue the rally after a huge gap up is if they guide higher. That's normally what happens. That being said, had you been a shareholder for Lululemon before these earnings, you're up 10%, and that's a very, very good gain nonetheless. Now with Lululemon out the way, let's talk about companies with the biggest earnings revisions for the second quarter earnings year. Now you can actually have a look. These are the mean estimate percentage changes. So essentially how much they got revised down, when are they expected to report next, and what is their predicted earnings for second quarter earnings coming up. Now not a lot of notable names right here. I guess Microchip Technology is something I have looked at. Energy, Hershey as well, Nordson Corp, Deere & Co. We're actually seeing massive downward revisions, 15% here for Deere & Co. Microchip is down 11%, and then Take-Two Interactive Software actually seeing the biggest estimate downward revisions at 96.6%. Kind of brutal when you look at that. However, looking at the earnings with the biggest upward revisions, we're looking at Vistra Corp Energy. This is essentially a utilities name, 97% median change, although not a lot of analysts are looking at the stock. Only 2 here, AES Corp as well, SBA, but we do see JP Morgan, 12.7% upward revisions. There's 9 analysts looking at the stock. Constellation Energy, there's 3 analysts giving up revisions of 11.9% right here. Deckers Outdoor 11.4% upward revisions, 11 analysts looking at the stock right here. Then Analog Devices, this is a semiconductor company, 10.8% upward revisions. That's very healthy for the semiconductor industry. 24 analysts revising up. And then we actually have Norwegian Cruise Line Holdings. I actually had someone in the live stream pitched me CCL and NCLH saying they're good buying opportunities right now, and we're actually seeing up revisions for those. And I'm assuming stuff like Carnival Cruises will probably see upward revisions as well, and probably positive earnings in Disney's segment of their cruise division. So if you are looking for earnings plays this quarter, you can either look at these and then short plays in the companies that are getting revised to the downside. So really positive big companies here actually getting revised up. That's what you want to see. So let's look at some macro. Today we got the ADP employment report. It's essentially the gains or losses in US private payrolls, and it really does a good job at determining what the real economy is doing. Sort of these small and mid-sized businesses tend to use the ADP products, and we could actually see here that the expectation was 174K. We missed by a wide margin, 152K. And then you look at that in totality, you might say things are falling apart, things are not looking that great. But when you dive into the details, things look actually a bit different. You can actually see here 20 to 49 employees actually lost 36,000 on a sequential basis. The expectation was a gain of 11,000, right? That's what affected this overall number. But then you look at stuff like 1 to 19 employees, 26,000 was expected. We came in at 26,000. Look at 250 to 499 and 50 to 249. The expectation was 48K, 30K. We came in at 49K and 30K. Even large size right here, beat by a pretty big margin. 86K expected, 98,000 gain. The problem was this right here. This affected the overall number, and that's part of the reason why the S&P 500 actually did rally today, because a lot of the data we got was, yes, things are slowing, but not falling apart when you dive into the details. Now, looking at some other data points, we got a little bit of a note here from both. They say the ISM Manufacturing Index fell to 48.7 from 49.3. This was below consensus of our expectations of a slight increase. Looking into the details, new orders fell 45.4, the biggest drop since June 2022. Production also fell to 50.2. Inventories fell to 47.9, and employment increased to 51.1 from 48.6, the highest since August 2022. Very interesting that employment actually expanded in that month. And customer inventories rose to 48.3 versus 47.8. In line with the narrative from our latest CapEx watch, manufacturing is potentially due for a mild slowdown after the unsustainable growth rates seen last year. Construction spending cooled slightly in April, falling 0.1%. Residential construction grew 0.1%, but the weakness came from non-residential, which fell 0.3%. Within residential, single family picked up 0.1%, multifamily fell 0.3%. Home improvement spend was little change at $319 billion. Construction spending has been relatively stable over the past several months, but still high borrowing costs and material prices continues to pose some headwinds. And pretty much what all of the data we looked at today is telling us that sure, the economy does remain robust, but we are starting to see deterioration, and that probably has to do with tight monetary policy. But diving into the charts, this is our gamma heat map. Not much has changed since yesterday, except the gamma flip zone is now at 52.65. 5400 is the core resistance. The put support remains at 5200, and I reiterate that 52.65 to 5200, this is our buy zone, and we want to look for highs at 5300 and 5400. We want to be buyers of dips until we sustainably get below the 5200 mark. Then we could actually look to further downside. Until we actually get below this level, buy dips, sell rips. 5400 is our maximum target into the June OPEX. Now, looking at current market cycles, this is S&P 500 cyclical bull markets, our current cyclical bull market transposed against every other bull market in the last 100 years. And the current bull market cycle is about 20 months old and has produced about a 53% gain in totality. So there's a lot of gas in the tank. By historical standards, there still seems to be life left for this bull, given the median bull market duration is about 30 months with an average gain of about 92%. And again, this is transposed over 100 years of data. So we might actually be closer to the middle than we are to the end of this bull market. So there is juice left in the tank, and be open to better than expected returns, even if we do get a bit of volatility here in the medium term. Now, looking at things that can produce volatility, we still have quite a bit of earnings this week. We have the ECB rate decision tomorrow, as well as initial jobless claims and a couple of other minor data points. And then on Friday is the big one. We have the non-farms and everything that comes with it, private payrolls, the unemployment rate, average hourly earnings, average weekly hours. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.